Okay, hi everyone. Thanks for joining our webinar today. I'm Alice Chen. I'm a partner at Pender Hastings Capital. We're a real estate private equity firm that invests in both Canada and the United States. We spend a lot of time studying both the markets and the operators. We look at hundreds of opportunities each month to identify exceptional investments, both in terms of the geography, the market cycle timing, and the operator. And then we back proven operators in the right market with capital to help them scale. On the flip side, we turn these operators' profitable businesses into funds that you can invest in. So currently we have 4 funds across 9 projects in our home market, which is Vancouver, BC, in Canada, and we're now expanding into the US and setting up our new funds here after studying the US real estate market in depth since 2022. So today we wanted to say hi and to share our observations and analyses over the last few years. I will interview our founding partner, James Livingstone, to share his perspective on the emerging trends we see in US real estate. We'll do that for about half an hour or so and then open up the floor for your questions. So does that sound good?
Sounds good.
Okay, great. So yeah, James, why don't we start with your background, and then we'll, delve into the questions.
Sure. Way back, I was a CPA. I was a CPA for 24 years. I was a partner in an accounting firm, so learned tax and audit. But my main practice area was corporate finance, helping growing businesses. And so I left that to enter private equity. So I spent 12 years buying companies. So I had a private equity corporation as well as a fund. So we purchased businesses like manufacturing businesses, distribution companies, service businesses across Canada, United States, and in England. And really, I guess the biggest lesson I learned from that period of time is that our success in buying businesses is based on the quality of the management team. And so it's not just, are they competent, but are they very competitive too? So the groups that really wanted to win, they always outperformed. I left actually during COVID. I couldn't buy businesses anymore; it was too risky, and I was looking for a change. So I switched to real estate, and I started by going down to Dallas. I had an office in Dallas from my private equity days, so I knew the market. And what I was trying to figure out is in multifamily investing, investors were earning 30%, sometimes 40% a year, doing a light renovation on an old building and selling it. And I wanted to know why. So I spent most of 2022 flying back and forth between Dallas and Vancouver. And the reason for the high returns, as we know now, interest rates had fallen, and then cap rates had fallen as well. So people who sold in that last quarter of 21 and in the first quarter of 2022 did very, very well. Interest rates started going up, and so by the end of 2022, I knew the party was over, and I hadn't made any investments, so I was fine. But I could see that a whole new strategy was needed in light of the present situation. So on multifamily, it's something I'm avoiding for a few years, just waiting for the rest of the market to sort itself out. And we're seeing lots of foreclosures now, in that market, just due to the increase of interest rates, which now we're hearing are about to reverse.
Okay, great. Thank you. James, at Pender Hastings Capital, at our firm, we study both the markets and the operators. So let's talk about due diligence on the market itself. So what are some of the macroeconomic factors driving real estate opportunities that we look at?
Yeah. So when I used to buy companies, we're always looking at the drivers for sales of the particular product or service. And real estate's the same. Real estate values go up with supply and demand. We've seen over the past years, the Sunbelt states have had a lot of population growth, so lots of demand for all types of real estate. So what we're looking for are a couple of I guess situations, and in a way they kind of contradict each other. So on the one hand, we like hard markets. What I learned from buying businesses is you make money doing things that are hard. If you're buying a business that anyone else can buy and to run, it becomes commoditized pretty quickly, low margins. And it's because there's no barrier. Anyone can do it. Whereas harder markets in real estate, such as New York, Los Angeles, Seattle, really the West Coast, a lot of investors get hurt there. So if I just by myself went and tried to develop a project in Los Angeles, I would lose for sure. Um, but by partnering with experts in markets that are hard, we can do very, very well. On the flip side, we'd also like some markets that are easy, but it really depends on what we're investing in. What we saw in 21 and part of 2022, as rents went up, say with residential real estate, with multifamily, they went up nationally by about 23%. Well, one developer, then another developer, and before you know it, thousands of developers were able to get funding and start building. There's so much data now available to everyone that it's not difficult to see. So the problem with that is that maybe the pro forma looked good at the outset, but by the time they've finished, it's tough. They're not hitting their numbers, and they're not hitting the numbers because they've changed the market. When you have thousands and thousands of buildings coming online, supply goes way up, and of course, what happens to rents? They go down. So that's the problem in easy markets, is that it is too easy. The entitlement permitting process is short. Whereas where I live in Vancouver, if historically, if you wanted to build, say, a condo tower, it could be 4 years, 5 years just for zoning. So it keeps supply way down. So as frustrating as that is, we have a market here where real estate's very, very high, demand is very, very high, and supply is very low. So it's actually, the perfect combination to have a business if you can solve the problem.
Okay, amazing. So why don't we go into the state of the US housing market right now? I know that you pulled some stats to
Sure,
showcase what's happening, but let's just go from a data perspective and look at what's really going on.
absolutely. So my undergrad was history. So I liked history, and with the accounting background, I like numbers. So I like researching and figuring out what's going on. So ultimately, with real estate, it's all based on people, isn't it? If we don't have enough people, there's no demand. So I'm always looking at what's happening with people. And now this is a national view, and of course, in real estate, it's local. So whenever we're looking to invest in a certain city, we're looking at even neighborhood by neighborhood. But this is a national story, and I think it illustrates how I think. So the blue are boys and the pink are girls, and what we can see, this is called a population pyramid, is that it's categorized by age. So boomers, which we've always heard of, baby boomers, they're right now around 58 years old to 78. So they'd be, say, from here, but they're starting to die off. And so that's why you're seeing a slope now. They used to be the largest cohort, and I guess they still are, but what's unfair is the boomers are given 20 years and everyone else has 15 years. So I'll show you some numbers, and boomers are still larger, but they have an extra 5 years. So they're actually kind of smaller by year. Uh, and there's a few trends that we'll show. Gen X, that's kind of this little blip here. That's where I'm Gen X. And then millennials would be 28 to 43 in that area. And then we hear about Gen Z, they'd be underneath that. So pretty much 10 years old and up. And then the kids are alpha. The kids are too young to own anything right now, but they're reflecting, those are the children of the millennials. And you can see the problem, and this Canada is far worse. Canada's huge amount of immigration to make for a declining population. So you can see the US population is starting to decline. So when we look at how many people are in each generation, Gen Z, 69 million, millennials, 72, and that's 15 years worth of people, and Gen X, same 15 years, 65 million. Boomers are 76, but if we pull out 5 years, it would be be less than millennials. have to start my slideshow. Here we go. So when we look at home ownership, so we're focused on residential. 79% of boomers own their own home, whether it's a condo or a house. Gen X 77, millennials 65, and Gen Z 30. So when I add up the differential between the 79% and say 65 for millennials and Gen Z 30, there's about 43.8 million people that will want to buy a house. And right now they're renting. We've seen rents go up in part. There wasn't enough rental as people shifted out of cities and moved around. But with interest rates going up and mortgage rates going up, I think mortgage rates have to look at them now, but a couple weeks ago they're 6.5%. Most homeowners, existing homeowners, don't want to swap a 3% mortgage for a 6.5% mortgage. So the market's kind of stuck. And what's also making it stuck is boomers don't want to leave. They want to age in place. So typically you'd expect them to sell homes and downsize, and we're not really seeing too much of that. We're seeing some, but not in the volume. So we have this massive need for housing.
Yeah, and James, I often see stats like there's a deficit of about 3.5 million single-family homes in the US. So how does that correlate to the numbers you're showing from, the number of the two generations wanting to become a homeowner?
Yeah, I mean, I think that number is way low. I mean, it could be true just from a raw numbers if you take the number of people, number of houses, but when you're looking at home ownership, it's not national, isn't it? It's not evenly spread out. So I think the number is far higher. What's clear is that and I didn't have time to get the graph. I'll add it for the next presentation. But after the Great Recession in '08, nothing really happened. If you recall back then, it was the housing companies that were really impacted. And it's not anything they did, it's just the banks pulled a lot of the financing. And of course, demand fell because people were owning 4 or 5 homes. So there's a lot of foreclosure. And the banks really didn't sell anything until about 2013. So the US economy really didn't get going again until 2015. And home building really didn't going back to where it needed to be at around 1 million homes till 2 years ago. So this long period of time where builders couldn't build, they couldn't get the capital, or they didn't have the balance sheet. They lost a lot of money, and so they had to slowly build again. So there's tons of demand. I think the demand is far higher than 3.5. And especially, I don't know if those stats take into account the fact boomers aren't selling. And then it doesn't take into account where, if everyone wants to own a home, say in Florida, versus say, Los Angeles, I doubt those numbers take that into account either.
Mm-hmm.
So in terms of, where's the demand? Lots of demand to buy first-time homes. Right now, there's a lot of pent-up demand for rentals, surprisingly, and that would be in the Gen Z. Kids are living at home with parents still. And so as rents come down, maybe that changes. But also people are staying at home to save up money to buy a house. And renters want to buy a house. First-time homes, I think the national value of a house right now is about 400,000. So depending where you're buying. But what's clear is more land is needed to build subdivisions. And also there's more, in the more dense cities on the West Coast and New York, there's more infill needed as well. So those are the trends I see. Ultimately, there's going to be more demand for senior housing as well and I'm saying that here in Vancouver. Vancouver, our population is about 25% is over 65. And a lot of the homes I'm buying to tear down and build multifamily on are owned by people in their 80s and 90s. So they're just now, in their mid 80s, they're selling houses and going into either just renting something or senior living.
Okay. James,
Uh,
can we go back and can you just elaborate on the difference between subdivision land versus infill? I know that these are industry jargons that sometimes people don't
sure.
understand.
Sure. In a place like, New York, say Manhattan, there is no land available. So there's no subdivision. So really, if you want to build something, you're having to tear an old building down and build a new one. And that's what we call infill. Subdivisions, places like Texas have lots of land. Florida, Georgia, many other states. So this is where a developer will get the land entitled, permitted, service, and then they can build 100 or 200 or 400 homes in a subdivision at once.
Okay, thank you.
Yeah, what I'll be talking about, as customers are national home builders. So there's a few really large home builders, D.R. Horton. They do a lot of entry level home building. 2023 revenue over 32 billion. Lennar over 32 billion. Pulte, 15 billion, and then there's quite a few in that under 6 and 5 billion range. So these are the companies. They're public for the first point. So as a public company, stock price matters. So the one thing they don't want to do, they really don't want to own a lot of land, because land is set up as a liability on their financials, which hurts their financial position. So they would prefer to work with private companies that are preparing the land. They really just want to build a lot of houses. And when they build houses, they'll build thousands and thousands. Like D.R. Horton last year, it would have been close to 80,000 homes built. Just a phenomenal amount of houses. So in terms of of what I see over the next 10, 15 years, there's demand for homes. The story the last few years has been multifamily, because a lot of demand to rent, and there'll still be steady demand to rent. Don't get me wrong, but as rates come down, as we're expecting them to, we'll start to see a shift where more and more people will leave rental to buy a starter home. And really, there's 4 different ways to invest in this. The first way is what's called land entitlement. So land entitlement is where a developer will tie up usually. They'll negotiate maybe 2 years with the owner to get the entitlements and permits. They prefer not to buy the land up front, because it would be very expensive and very, if they can't get the entitlements, they could lose a lot of money. So they'll take anywhere from 14 months to 2 years, depending on how big the land is, to get the zoning and permits they need. And then what they do is they sell it to a national home builder. There's lots of demand. Even though there's lots of land out there, there's not a lot of entitled land out there. Many states, the federal or state government owns the land. There's parks. So in places like Florida, there looks like lots of land, but Everglades, takes a big chunk of it, and there's some land that's just too difficult. So the national home builders have a big appetite for entitled land. Once the land is permitted, the national home builder typically will sell that to another land developer who puts in the services. And sometimes they'll do it themselves too, but often what I'm seeing is there are companies that just are specialists at servicing land. So they'll buy it from the home builder and put in the water, the sewer, so all the pipes, as well as roads and any of the the dirt movement as well. Once that's done, then they'll send it back. They'll sell it back to the home builder, and then they'll build houses.
Yeah, and then
So
often we see that they're selling the land, entitled land back or service land back to the home builders at a pre-negotiated price, right? So removing the
yeah,
risk of
yeah,
exit.
it really depends. But some of the bigger home builders like D.R. Horton, they'll have an agreement where they'll buy it. So that's nice. So for the land developer, they don't have to worry about the risk of who's going to buy it.
Mhm.
And what we're seeing on these, it's quite a range of what's getting permitted. There'll be, say, a 20, 30 acre parcel is likely just all single family homes, but we're seeing, large 300, 400, 500 acre sites. And it's a combination, it's single family home subdivisions with, BTR. And some of the BTR communities are 1,150 square foot entry level housing for workers, multifamily sites, retail, industrial. It's all over the place. So, but mixed use master plan communities, those are, you need a few hundred acres to do those.
Yeah, and
And for
BTR is basically known as the horizontal multifamily, right, these days. And
right,
why is that?
yeah,
Why is that such a topic right now?
yeah. Well, and you just have to go back to demographics. So as people get married, they start having children. A studio or 1 or 2 bedroom apartment isn't going to cut it. And when you look at what's being built, it's largely studio one bedroom and 2 bedroom apartments. They're not really built for families. So the option, if you're a family, is to either buy a house or to rent one. So people can rent usually, maybe there's some older homes available and maybe some new ones, but a lot of developers will just build an entire subdivision of 3 and 4 bedroom homes and rent those out. And
Hmm.
that's built to rent. For us at Pender Hastings, I used to buy companies, and it would take a long time to buy, to build a company. So these would be 30, 40, 50 million revenue businesses. They're good businesses, but to grow them, you have to, add people. You have to always improve systems, culture. It doesn't happen overnight. It takes years and years and years. And so any long duration investment like that, you're prone to disruption, as we saw with COVID. So for me as an investor, I used to be, ultra long term, and now I'm really short term, especially as tensions rise, global politics, and just how everything is interconnected, as we saw with the pandemic, with supply chain and profitability. Um, I'm targeting investment opportunities that are short because I can get in and out and assess risk, continuously. So in terms of land development, really like that because it's typically short, 18 to 24 months. For some of those very, very large multi-thousand master plan community, acreage projects, we're not doing those. Those can be up to 5 years. But for us, it's sub, 2 years. And the capital requirements are typically small, like 1 to 5 million, even for 1,000 acres. It's on the entitlement side, it's not a lot of money. Um, so for us, we're doing that. We're also focused on single family home building, just given there's still not enough. And there it's just about markets. So we're starting in pockets in Florida. Whenever you read headlines about any state or anything on real estate, it's just noise. There's parts of every city or state you don't want to invest in. You can take Dallas, and there's lots of parts of Dallas you'd never want to invest in. But then there's areas that are terrific. So it really is a local type of investment. So for us, we do our due diligence and look at the data and then find, the pockets that we know we can do well in.
Thank you. Yeah, so a lot of times I meet real estate investors that's very debt focused, so they like hard money lending. And then, the funds that were setting up their equity base. Can you talk about the main differences between or the risks and rewards between investing equity versus debt?
Sure. I know a lot of investors who invest in multifamily. One characteristic they liked about multifamily were the monthly distributions. So they could expect 5 or 6% cash flow. And I'm part of some passive investing groups in the United States. And many people are, some people are working, but then there's quite a few retirees. So maybe they had they were a corporate executive or they had a business, so they had, a few $1 million, and they bought a lot of syndications and multifamily in part because of the income.
Hmm.
Um, so what I'm seeing them switch to are debt funds, as an example. So with debt funds, uh, it's that steady 8 to 12% return depending on the type of debt fund. But you can invest in first mortgages, which would be lower return. You can invest in second mortgages. You can invest in mezz debt. So I know funds that just focus on subordinated mezz debt that they lend to companies or to developers. So the returns are higher, but the risk is higher too. So there's a whole realm there. Preferred equity has been popular lately in, say, multifamily, where the thesis was there's all these foreclosures happening and these struggling balance sheets. Why don't we go in and get in front of the equity holders? So there's been some of that as well. So you can also invest in preferreds. but it's obviously that, that constant cash flow that people like. Equity, of course, there's usually no distributions. And this is why I focus on short duration versus long. So not just because of risk, but also short, you get your money back quicker. So if it's 18 months, you get your money and your return, and then you can look at the market again and decide where you want to invest next.
Hmm. Yeah, and typically we look at what's called the equity multiple. Can you just go through kind of the main differences between that versus like annualized returns versus IRR?
Sure. I'll use multifamily as an example again. So many of those projects were five-year holds. So they might say, equity multiple of 2. So what they're saying is if you put, 100,000 in, you could expect 200,000 back 5 years later. So that, that 100% return over 5 years, you divide 100% by 5, it's an annual return of 20%. Uh, the longer you hold an investment, though, even if you're steady at 20% annual return, a 20% return made in year one is worth more than a return that you make at year 5. And so this is where the industry uses IRR. I think most individuals, don't really think in terms of IRR, but it's really time value, of money. So a 20% annual return over 5 years is equivalent to a 17% IRR in today's money. So still a good return. It's more the realm of institutions, maybe RIAs, life insurance companies, corporations that really care about IRR because they have a cost of capital. Most individuals don't think in terms of their money as having, a cost to it.
Yeah. I mean, the way that I think about passive investing is that's often a trade-off between um, cash flow, so passive income, like immediate cash flow and passive income versus the growth of the capital. So that's
Yeah,
equity multiple. So I think that then represents a spectrum investments from equity to debt, right? So people need
yeah.
to kind of get clear about exactly what their objective is before aligning with a strategy.
Yeah, and people don't invest all their money in one strategy either. I mean, if you
Mm,
look at asset allocation principles, um, someone who's 70 is going to have a different asset allocation than someone who's 35. Uh, so liquidity is part of it. How liquid do you need your investments? If you need liquidity, then don't put all your money into real estate. If you don't need liquidity, then it's not just real estate, but there's private equity, venture capital, what we term alternatives that can be a fit. But it really is an individual by individual decision. And of course, diversification. So people typically have stocks, bonds, and then we'll have a range of other investments as well.